Mark Gagan, and you're listening to a special episode of the Voice of Insurance podcast, produced in association with Calibrant. Today's episode is fun and insightful from start to finish, and that's entirely down to my guests. One of the great Eureka moments in insurance comes when you meet an actuary who's a great communicator. 5 minutes chatting with them usually unlocks understanding that would take you years to glean yourself, or which indeed you may never have worked out without their help. Luckily today, I'm talking not to one, but two such people. Simon Pollack is the founder and director, and Owen Whelan is the Managing Director of Calibrant, a really interesting, relatively young business concentrating on portfolio management, particularly in the burgeoning field of Delegated Underwriting Authority. With MGAs continually gaining market share and also garnering extra scrutiny from senior managers and market regulators, Calibrant is in a fast-growing segment of the market. The core of what Calibrant and its Sybil software platform does is to wring improvements to the loss ratio of underwriting portfolios through joined-up, granular analysis. It sounds simple in theory, but in practice, bridging all the gaps between the underwriting, reserving, pricing and senior management functions is the culmination of Simon & Owen's multi-decade experience in the industry. This is a duo right on the top of their game, and this podcast is absolutely packed with valuable insights garnered from long and successful careers in our business. Simon & Owen met as London market drinking buddies, and you should think of this podcast as a very enjoyable chat in a bar with two great friends and a glass of your favourite tipple in your hand. You'll learn a lot, and after listening to this, I expect you'll want to spend a lot more time with this fun and down-to-earth duo. Enjoy the podcast. Owen and Simon, welcome to the Voice of Insurance.
Hello, Mark.
Hi, Mark.
Anyone who doesn't know you, why don't you briefly introduce yourselves and also tell us how you got into insurance and then run us through your careers to date. Who's going to start?
I'll start. So I'm Owen Whelan. I'm an actuary of 30 years now, coming up to my 35th year in the industry. I started at the tender age of 17 in an insurance company in Dublin, and I've had many actuarial roles over the last 35 years or so, all with insurance companies prior to Calibrant, covering most lines of business, predominantly commercial lines, London market.
And how did you first get into it? What attracted you at that age, 17?
I was a numbers geek at school, so I was a maths person. So one of my teachers said to me that I should consider being an actuary. So I applied for many roles and got offered one in Dublin and took that.
Simon?
Fairly similar, except I started at a more sensible age, 21, after doing my degree.
Was it a maths degree? I presume.
It was a maths degree as well, although Owen, because he started so young, didn't actually do his maths degree. But I got my maths degree, like most actuaries do. I'm an actuary as well. Similar sort of vintage. Owen and I are similar age. And I was just reflecting that we have been more drinking buddies over the years than work colleagues, but eventually the opportunity came to work together. And that's how we find ourselves now both working in this company.
So you came together. Had you worked together before, or were you just mates?
We were just mates. Although we're in the same industry, you have a lot of common intersecting circles of friends, don't you?
Yeah, and does the actuarial community have a sort of social life, and does it have a sort of subset of the CII or something?
Yeah, so there's all that kind of stuff. But when your life exists in spreadsheets, I think we know that the London market, at least historically, had quite a drinking culture. That is absolutely replicated in the actuarial field because actuaries just love to let their hair down after 8 hours staring at spreadsheets.
Which one's the actuarial pub?
Any pub will do, really.
Any pub will do. Okay, so you haven't sort of worked out mathematically which is the best pub?
Probably, but that's more Owen than me. He's more technically gifted than I am.
So you were good friends, and presumably you were in the pub, and did you instantly come up with this idea for Calibrant?
Well, no, actually, the funny thing is, I was the original founder with a small team from another company. And after it was set up with a bit of success and having 5 people working for us, I actually did this sort of sensible thing. I put a sensible hat on and I thought, I need continuity in case I die. It really was as simple as that.
Well, that's thinking like an actuary, yeah.
Yes, it is. And so I asked Owen, who at that time was working for Aviva, I asked Owen if he'd be willing to come on board as a non-exec to help give the business a little bit of security, stability and breadth. And so, longer story short, after about 6 or 12 months of that, and Owen found himself between jobs, we then had the conversation about whether it was something he wanted to turn into an actual executive role.
And so, what's Calibrant all about? What are the problems you're solving? Was it one of those things that you thought, there's this massive problem or this huge market here for what we're trying to do? Anyway, how did it all come about?
It kind of got shook out of a corporate restructure for a company I was working for at the time. And Owen and I, both actuaries as we've established, but both of us have also become, in the latter stages of our traditional actuarial career, more into the sort of underwriting executive roles. And so I was overseeing books of MGA business, among other things. And in this corporate restructure, some stuff got shaken out. The details are too lengthy to go into. But I saw an opportunity. I'm someone with a bit of an entrepreneurial bent, I think. But at the same time, I wasn't going to risk the great salaries that actuaries have to set up something that is incredibly risky. So I was waiting for the opportunity, the idea that would have some legs, where there's something which you can do that other people don't do. And that was really where Calibrant came about. So through this corporate restructure, I talked to the executive management of the company and I said, you've got us doing this at this moment. It's a very focused role. If we achieve the following pretty challenging commercial objectives, will you agree to let us leave the company but still provide the services? But as an outsourced person, you become a fee payer rather than a salary payer.
Yeah.
That happened. We met the goals. So we had effectively then a core key foundational client that kept the lights on.
That's great because that takes the risk out.
It does, and I didn't need to go into any external funding, and the team was there in place already working on the work that it was doing. So that's how it came about, and the idea fundamentally is portfolio management, which obviously around MGA business is a key element of long-term success.
So that's the problem you're solving, the management of portfolios. And what sort of portfolios?
All the portfolios we work on today are MGAs or schemes or some sort of portfolio underwriting, where decisions are being taken at the portfolio level rather than the individual contract level. Most insurers have invested lots of time, resource, money in managing the performance of their open market books. So they've got pretty good processes that link together the pricing, reserving, the underwriting of these portfolios. In our view, there's a lot left to be done in managing MGA portfolios. There's a lot of money on the table, in our view. Certainly a few points of loss ratio improvement can be obtained by managing delegated portfolios better. We can go into the details in a little bit, but it's basically better use of data, better joined up functions within an insurer, and also better capabilities within the MGAs themselves.
I think it's worth mentioning that the opportunity is that, as Owen articulates, it's something that if you do it well, you do get enduring combined ratio points of benefit, usually loss ratio, but you can also do more efficient stuff. But it's unglamorous. Insurance companies like to, especially individual underwriters and underwriting teams, they like to write a new line of business or issue a new product, develop a new distribution channel. They like the frisson of underwriting and
there's nothing like new risk and new revenue.
Exactly. And so that's where a lot of people's juices flow. And what's left behind, the stuff that falls through the cracks behind the sofa, is once you've got the portfolio, like a flower bed that needs nurturing, once you've got the portfolio, if you don't actually look after it, it will sort of gradually deteriorate, like entropy. So the idea is do the unglamorous stuff well and consistently over time, then you make some more money. But you've got to turn the unglamorous stuff into something which is efficient and fun. You can't do it just by grinding yourself through analysis.
So you're pulling out the weeds, adding fertilizer,
absolutely,
and really extracting the yield that crop really deserves.
That's right. And then delivering the flowers to all your dearest loved ones.
Excellent. No, but that makes a ton of sense. I was looking at your website and you're licensed, you're a broker, effectively. How do you go to market in terms of what you do? Or how should we think of you? As a consultant or as a broker or an MGA incubator type?
Well, we're not an MGA incubator. We're not a pure broker, although we are a registered, licensed, authorised
intermediary. Yes, that's whether you're registered and authorised as a broker,
yeah.
which is a good thing to see.
Yeah. Among other things, that gives you a certain credibility. You are able to do deals. We do have some situations where we have placed an MGA with a carrier. It also means that when we charge fees for that, we don't charge VAT on it, which is always good.
Oh, that's quite nice.
Because if you're an advisor, you sort of have to.
Insurance premium tax on it, if it's UK or not?
That gets charged, but we don't charge it.
Oh, you have to charge it. Right,
yeah. So, but if you were to facilitate a deal and you're not an authorised intermediary, then it's advisory work and you have to charge VAT on it, which is a pain.
Goodness. Yeah. Oh, right, that's no good.
So we are an intermediary. That is just part of it. We've got three main thrusts of what we offer. One is the deal making, the actual intermediation. And that's something we've done 2, 3, 4 times, large deals.
But it sounds like that's not what you're setting out to do. That's something you can do.
That's right. So the other thing, which is really more important for us, is deal servicing. So we always try and be on the front line, on the commercial cutting edge of stuff, because advice per se can often go into a report and gather dust on a shelf, can't it? And so offering advice and being paid for it is not necessarily the best way to have an enduring business model. I think we've all been there, particularly
if you're a middle manager and the senior manager says, I'm going to commission a report and pay X thousands of pounds for it. And then you sort of slightly resent the fact they've done it. And you think, actually, this is sort of teaching my grandmother to suck eggs. And it does gather dust.
Yes, exactly. This is not on topic particularly, but I do remember I was once working for a large insurance company who brought in a large strategic consulting company, and they did a £20 million job or something. I don't know what it was, but it was millions.
Well, they make sure they charge an eye-watering amount so people assume that it must be good.
And then they did that. That created a role that I did. And then 3 or 4 years later, a new CEO brought the same company in, who then did another review, which caused a complete restructure, which did away with the same role. You go...
Yeah, we've been there before, yes.
It's kind of pointless, isn't it? But we like to be on that commercial edge where transactions are happening, because that's where value is created in a business. So deal servicing, and that can be an intermediation role. We can sit between an MGA and a carrier, or it can be more advisory, but it's about getting insights that make the profitable
But the revenue
deals
sounds
happen.
like you do generally take commission on the premium.
Not exactly. Well, I'll come to that in a minute after I've just... The third aspect, and I do want to get the third aspect in, which is where we add most of our value, at least behind the scenes, is that we've got a third string to our bow, which is software. We have built a software package which facilitates a portfolio management process for, in any circumstance, whether it be for an MGA, for a carrier of MGAs, or indeed for open market business. So we've got software that really supports our business.
And that's Sybil, isn't it?
That's called Sybil, yes.
So, yes, let's get back to that revenue model. So you send a bill for your services, or do you just deduct a commission of the premium? Or I suppose if you're acting as a placing broker, as effectively a sort of binder placing broker, then that's fine. You do the standard thing that happens there.
If we're a placing broker, we take a commission. And most importantly, we provide an ongoing portfolio oversight service. So it's not just to bring the parties together in year one, but as long as we're engaged, over a multi-year basis, we provide an ongoing portfolio management
That's all
service.
included in that commission.
And that's included in the commission, yeah. And that's definitely a distinct, unique part to our proposition. But going back to the revenue model, if it's a one-off job, then we charge a fee for that, as any consultant would do. We do a handful of one-off jobs every year. So we're currently helping a small MGA get started. And so that was a one-off pricing piece of work. But more of our revenue and more of our activity is in ongoing portfolio oversight.
So it's there, and so that's commission-based.
It's a fee-based, but the fee is generally linked to the size of the transaction, because the value that they get, loss ratio reductions, typically 5, 10, 20 times what we charge in terms of loss ratio.
But you're not looking for an angle on, you don't get a kind of profit commission on how much you reduce the loss ratio by? Or
we are open to conversations.
That's not generally, people, but you get paid and you do your job and they get the benefit.
If somebody gives us the authority over the MGA so that we can pull sufficient levers, then we're open to having a conversation about being remunerated.
Because we do have one
commission.
large deal that we work on consistently like that, where we are actually, our work will affect the changes that need to be done to make sure the portfolio runs well. And that's where our decisions then can be rewarded with a profit commission, and we are on.
And this cadence sounds like it's sort of quarterly review type stuff.
For most of our clients, it's quarterly review.
Yep.
For our biggest client, it's monthly. It's as required for the portfolio. We have some that are small, emerging, relatively new MGAs, and they're 6 monthly. But quarterly is typical.
And what sort of size and scale have you got to in the company at the moment?
Well, you mentioned Sybil earlier, Mark.
Yep.
Sybil is really quite a big plank in our business now, because not only does it support the Calibrant work, but also we're licensing it independently to
So a
people.
third party can just
So,
use it.
yes, so it's actually, if you like, it's probably the second or third of some really big, important strategic pillars of our business. And so the way Owen and I split our time, Owen is in charge now of Calibrant, and I'm in charge of Sybil. So we work behind the scenes as a team.
And so you're a techie as well.
Well, I couldn't program to save my life, but we've got people who do, and they're very good. The tech business is a little bit different because you're charging annuity type of license fees on the software. We add services around that, especially around actuarial insight, but we're earning license fees on the software. And so Sybil has got, from a standing start about 2.5 years ago, without any external investment, we now have about a dozen clients running about 20 different portfolios through the software. This doesn't include the Calibrant work. So independent of Calibrant, we have 12 clients, 20-ish portfolios, probably around about £600 million running through the software now. Those portfolios vary in size from sub £10 million to north of £100 million. And they cover all lines of business, some personal lines, mostly commercial lines, some quite specialty stuff. Some of it's very cat exposed. A lot of it is SME.
So it's going very well. So it sounds like this is the way you differentiate yourself. This is your proprietary software, but you can license it to third parties.
That's right.
They get to find out about it because you're saying, by the way, we use this. You can license this if you would like.
Yes. When Owen and I have a new opportunity, well, the first thing we do is, do we think this is more of a software thing, or do we think it's more of a services thing or an intermediation thing? And we adapt our discussions with people according to what we think is going to be more interesting for them.
Quite often we're wrong.
Yes. Yeah.
Because you go into a conversation with an expectation that it might be a services contract. We kind of end up having a software discussion, or vice versa.
Well, the good thing is that you can do both. So,
Exactly.
And, they're both at the core of what you do. And how many people are working with you now?
We have about 10 across the two teams. We are constantly tweaking the team size. We've just about hired 2 new software developers. It's going all guns blazing, at least on.
And we should think of you as currently a London market business, London-based business rather
We're
than
London-based, and although Owen and I both have got our emotional roots in the London market and Lloyd's, we actually operate more outside of the London market area than within. Actually, most of our portfolios are, let's say, SME for a medium-sized insurer. Yeah.
Right. So really kind of the core general insurance business.
Yeah, and with kind of pretty much line of business agnosticity, if that's a word.
Well, the numbers are the numbers, aren't they?
That's right. I was thinking about this coming in here this morning, Mark. What is it that we wouldn't do? Well, if we draw the lines around what's amenable to our approach, and I'm sure we'll talk about portfolio management in a minute, about what it means to us. But for us, you need to have identifiable patterns that are available in a book of business to be able to make decisions about where the direction of that business should go, right? So if you've got a book of business which is 25 individual large contracts, then your portfolio management is 25 individual decisions every year. That's not where we're at. So you need to have patterns that are identifiable in some way. Where the numbers really inform you.
Yeah.
And the other thing is, you can't go in the other extreme, where you have a £2 billion motor portfolio where effectively 25 data scientists are turning it into an algorithmic underwriting enterprise.
So you've got a sweet spot, so somewhere in the middle, somewhere Goldilocks for you,
so
where
enough
they really
patterns
need
in the
you
data.
and you can add some value.
Enough patterns in the data and human decision making. That's the really important thing for us. But I still think that if you drew the lines like that, you're still probably covering 80% of the world's GWP. The $2.5 trillion of premium is our target market, Mark.
It's not, and you're growing. How long have you been going?
We set up Calibrant just over 4 years ago in April 2021. Sybil started towards the end of 2022. So Sybil's been going for 2.5, nearly 3 years. Calibrant's just over 4 years.
You said at the beginning, implied that you did it all without investment. Is that right?
Yeah, Owen and I are shareholders. All the shares are owned by our staff.
You're able to bootstrap it all.
Yep, absolutely. And never had a red year yet.
Yeah.
So that's
and
good.
I suppose, but then the setup of Sybil would have cost money, wouldn't it? I mean,
it did. And so,
capital.
To be honest with you, Calibrant, if you set up a business with a foundational client and you've negotiated a good contract, which we did, then we had surplus funds. And so although Sybil needed money before it started getting revenue, that money can come from the Calibrant. So we're all self-funded.
That's excellent. That's really good to hear, because most of the people I talk to, they have got a private equity fund or sovereign wealth fund or whatever it is. They've got some other sort of someone else who's
we
effectively
dance
their
to
boss
nobody
somewhere.
else's tune.
Really, really good to hear. Let's get into portfolio management. This is right at the core of what you do. Do you have a methodology?
Absolutely.
What's your modus operandi?
First and foremost, what we're trying to do is help our client, be it a carrier or be it an MGA, implement a robust control cycle. By that, what we mean is they understand current underwriting profitability, segment that profitability into the various different components of the portfolio where they can take underwriting actions, and project that forward so we understand the profitability of the business being put on the books today. And then with that information, our client can shape the portfolio and improve underwriting profitability.
So you're looking quarter on quarter, month on month, saying, well, yes, actually, the theoretical profitability of the business today is not quite what it was last month, is it? What's happening?
Yeah.
What can we do about it?
And a key part of what we do is to understand how the profitability of the book changes across time. So we're looking at underwriting actions, rate changes, inflation. What was the impact of COVID on claim frequency? What was the impact of going into lockdowns, coming out of lockdowns, things like that. Things that have impacted the patterns that we see in the data historically. From that, we forecast future profitability and we can reshape that portfolio to extract more profit.
And let's talk about two really sexy things for a second. Silos and
Yes.
granularity. Because I think those are the two things that are really important to understand for what we do here. So silos.
That's where you keep missiles.
It's all grain. Maybe this is a bit of corporate gobbledygook, but the idea that functions don't talk to each other in large insurance companies, or sometimes in small insurance companies. Pricing doesn't talk to reserving. Underwriting doesn't talk to actuarial. Finance has suspicion of underwriting. Underwriting doesn't understand accident year. And when you have this situation where you've got people who draw barriers between their teams, you're not going to be able to do what Owen has just articulated, which is we need essentially pricing insights, because we need the rate adequacy of the portfolio and the component parts of the portfolio at every moment that we're looking at it. Because if you've had a crap history that's delivered 110% combined for the last couple of years, but you've just whacked through a series of 38% rate increases, it's probably in good shape now. So you need to be able to
just
forward
still,
project.
Still got red ink in it, but that will be washed away by the tide of black ink
you
later.
need to be able to accept that those changes, you need to give value to the changes that are in train. So you need to be able to convince that if a reserving team, for example, says, I'm not allowed to take account of changes you've told me about that I haven't seen evidence in the data yet in my projections, then a portfolio like that could be projected to continue to deliver poor results. And a CEO sitting above all of that might make a bad decision to terminate the portfolio, say, even if
It's just about to come good.
it's about to come good. Yeah. So you need functions talking to each other.
Fun thing about having you is that you can do some of that function. You can join all these little
That's
dots
exactly
together,
what
can't you?
we do with portfolio management, what Sybil facilitates. Yeah. And the other thing is granularity. And this is less sexy. Granularity. If you don't have fine-grained insight, you're going to take sledgehammers to a portfolio instead of a scalpel. You've got to be able to say, okay, 75% of this book is running well. 25% needs fixing. You need to be able to break the portfolio down into 1,000 different units, right? And say, these 800 are doing great. These 100 are okay, but these 100 here actually need fixing. And fixing, by the way, when talking to Owen in the early days of Calibrant, Owen, with his experience, he told me early on, he said, all these things you need to do to try to fix a portfolio, refining the risk acceptance criteria here or putting a sublimit on the policy here, none of it works as well as rate. And rate is really the key thing. But identifying where you need to adapt your rates, and sometimes even cutting rates. A hard market, are you closing the floodgates to maintain a 38% loss ratio where, a 10% rate cut could open more business to you?
Yeah, you could be making a lot more profit.
Exactly. In absolute terms, if you were to cut rates in a hard market sometimes.
You sell more.
Yeah, exactly.
Yeah. Sell more, make more.
But rate is it's not the only one, but it is probably the most important lever to pull in managing a book of business.
Or is it stitch in time saves 9 always to be able to nudge it earlier is always better?
Absolutely. Forecasting, and this is why we look at rate adequacy. When Owen talked about the business being written now, in our approach, we always have an idea at any point in time, the end of the month, we know for those 1,000 different units in the portfolio, not only where they've been in the past, but we've got a very good estimate, or as good an estimate as you can get, let's say, of what we think the rate adequacy of each of those bits is.
So your output is always going to be saying, we believe this to be X amount profitable.
Yeah, and the loss ratio for this bit of the book over the next 12 months, we expect to be 48%. For this book, we expect it to be 56%. And that's informed actuarially and by all the actions that are in train and have taken place. But it's also informed by also the history and things like that.
A key part of what we do is a transparency of our assumptions. So within Sybil, it's very easy for our client to see, or for a third party if the client so wishes, what assumptions we're making about historic profitability, about IBNR patterns, about rate change and inflation and so on. And if somebody disagrees with that, they're free to come up with their own assumptions and do some what-if analysis. And that's really simple. Transparency of assumptions is a key tenet of what we do.
And it really facilitates, because back to that kind of silo point, I did an MBA once, so
if the underwriter doesn't know what is good,
yeah,
then
exactly.
and that's
what
they
I
need to be informed, don't they?
Single version of the truth and what good looks like and that kind of stuff. These are the really important principles that you need to be able to manage a portfolio successfully. That involves breaking down the barriers between silos, and it involves transparency. So these are really important cultural aspects of what portfolio management's about.
And that's 75. I know rate is king, but in that 75-25 scenario, where it's always the 25 that spoil it for everybody else.
Yeah.
Well, how do you remediate that? Is it you just get rid of those 25, or you apply rate to those 25, particularly, and then some of them will fly away and of their own accord in a competitive market, and therefore, but some might actually take the rate and say, yeah, I want to stick with you. Then you've remediated it.
You're teeing us up into some really quite insightful stuff about what the software does, right?
All the secrets, you see. The things we can't do it unless you've got all your software and you've got all the data and you know what you're doing.
No, but that is exactly the right approach, Mark. I mean, it's like you've got a number of possible decisions to make, but you need to make them at a fine-grained level. So you need to identify those areas. You need to decide what you would like to do. You want to test what you might do. And so exiting is quite extreme. So normally you'd say, but we can sensitivity test things like elasticity assumptions. Most of our models that we do have got elasticity assumptions. So we can say, if you were to put in this rate on this section of the portfolio, what might actually happen both to the profitability and GWP.
You'd say,
right?
well, you'd probably lose 7% of them.
Exactly. An elasticity of 7 means you would lose 7% of the book for a 1% rate increase. And we've got rough rules of thumb for where we think elasticity is out for each line of business in each market. So we can test those things out. And also we can give credit for the effect of a dilution of a rate action, for all the jostling around where you get some anti-selection type of things, where the people for whom a rate increase looks unattractive, but they're a good risk, they might leave you and things like that. So yeah, it's quite involved when you get into the weeds of it.
I was a broker. I never used to have to think about this kind of stuff. I just lived from hand to mouth, from one wrist to the neck.
GWP was very important to you.
Yeah, I suppose I was too junior. I never really thought about it in a round. Only by the time I was leaving that I started to actually think about it. And it was only when I became a journalist I had to really think about everything in the round, because that suddenly became my job to do that.
Yeah.
No, but this is really, really good. What about the wider picture? Obviously, all these MGAs have got... MGAs, obviously, at the absolute base, every MGA has a conflict of interest with the carriers behind it, because they can just write for commission, write for income. Okay, it's not a very good long-term strategy. We all know that. But there's a natural inbuilt conflict.
There is.
And also, what do you do for the carriers? You're working for the MGAs,
Either. Some of our clients are carriers, some of our clients are MGAs. Yeah.
So you're really in the middle, or you could be doing both, and you're really smoothing that relationship.
And sometimes we're facilitating a transaction, in which case you've got a legal client potentially, but you're there to provide insight in the middle. But yes.
So alignment of interest, I mean, is it all really about profit commissions, etc., making sure they're properly calibrated?
Profit commissions are a carrot. You sometimes need a stick as well. And this volume and margin dichotomy is, you correctly identify it, it's a really powerful point. And it's been the reason why so many MGA carrier relationships have broken down over the years. But the key principles here, think of carrots and sticks. Carrot would be, if you do well by my terms, thinking of as a carrier, if you do well by my terms, we'll reward you. So profit commission. So an ideal contract from a carrier's point of view has enough commission in there to keep an MGA's lights on, but not enough to make them rich, and a profit commission that reflects profitability once they've hit certain hurdles. Also, some kind of exit rights if things don't go well. Now, flip that into, think about it from the MGA point of view. They would like not to have to spend their entire life chasing around for capacity every year. They would like multi-year deals, ideally contractual, or if at least in practice, multi-year relationships. So if you've got a situation where you've got a relationship between a carrier and an MGA where you've got the profit commission so established in that way, there's the carrot. You've got a multi-year relationship where you've got a clear definition of what good looks like and how you're going to measure it. This is the transparency point. And the carrier has the right to be able to exit reasonably quickly if things don't go well and things are not remediated. Then you've got the stick in there as well. That's the stick that the carrier can produce. So you've got an incentive to do well, an incentive not to do badly. You've got rewards if you do well as an MGA, and you've got a multi-year relationship that means your management can actually think about the business rather than constantly chasing your tail for capacity. And we've got contractual terms. We are not just actuaries. We have built DUA contracts with certain features in them. In fact, that's where Calibrant got its name. We call it the Portfolio Calibrator. So the Calibrator gave us this name, Calibrant, and it's a set of contractual features that make sure that the portfolio calibrates itself to mutual satisfaction between the MGA and the carrier.
It sounds like you earn your fees.
Our fees are very modest compared to what we do, Mark. Very modest.
What about the data side of it? Again, to get that granularity, do you use any third-party data to sort of benchmark? Or are you benchmarking one client against another, for example, the sort of thing a consultant might do?
The whole data topic in the MGA space is a podcast in its own right. So
I presume it's frustrating, like to ingest all that data in the right way, in the way that's useful to you?
Yeah, so the data required for portfolio management, portfolio analytics, is a small subset of the data that's generally available within the bordereau that fly around the market. And also, they tend to be the key important items of data. They're usually recorded correctly, so data accuracy around those features is rarely a problem. So we provide our clients a data management, data cleansing service. So if they give us their data, we can map that, cleanse that, so that we're able to use it to extract value.
We have 4 actuaries, a couple of data scientists. We're well geared up to be able to
do that.
So really, to make it sure it's all clean and proper.
Yeah, but data doesn't need to be perfect. It only needs to be good enough for the decision that's being made. If a portfolio is running at 105 or 110% combined, you need at least 10 or 20 points of rate action.
Data can't ever be perfect, can it? Because it's already out of date by
definition.
And it already becomes history by the time it's hit that spreadsheet.
And most people lose the plot a little bit by chasing the perfect data, and they're missing the point of, so what? For example, we had one recently. It was a medium-sized MGA, and they gave us some data, and they realised that they missed off midterm adjustments. And you would say, well, okay, so midterm adjustments account for what? Well, it's about 2% of the risks every year. And so you go, well, to be honest with you, we can ignore that. We don't need to spend the next weeks finding the right data. As Owen says, when a portfolio is good or bad. 1 or 2 points of loss ratio might not be the point here, and you need to just
if it's a dog, it looks like a dog and it smells like a dog, and if it's a pussycat, or the other way around, or a cute puppy, or a horrible sort of mongrel.
Yes, exactly.
But I think, just continuing on the data point for a moment, the market has spent a huge amount of money on bordereau management in the last number of years. We think many of the people are missing a trick in portfolio management. The way they run these projects, the way they implement the software and so on, they're not doing it in a way which lends themselves to extracting more profit from the business. They're doing it in a way to tick compliance boxes, to make sure the taxes are paid and so on.
That's certainly been the motivation, particularly in the London market, hasn't it? You must ingest data to this standard, to this format.
5.2,
etc.
bordereau format.
And all those different things that are slightly, you can lose your mind if you start to try and understand them all.
Yeah. But I think sometimes just stand back and think, I've invested X 100,000 in implementing these platforms. How do I get some value out of it? You can get some value by reducing your loss ratio and actively managing your portfolio. And paybacks will be, in our view, pretty quick.
That's really good to hear. Let's talk about another big philosophical question. We've had I would say it's fair enough now because we've been through a cycle or two. The MGAs have increased their market share of almost every market, right the way through the value chain. What's been driving it? Because we've been through hard and soft cycles. Okay, in every hard cycle you do, MGAs will have a bit of a thinning out, but then so will underwriting divisions have a bit of a thinning out. Companies will exit lines, whether they're doing it via an MGA or via their own underwriters sitting at their own desks on their own paper. So what's driving that? Because it doesn't seem like it's going away and the growth seems to still be set in. So you're in a good segment of the market.
Well, this is the kind of commercial value of the business we're in, I think. Everyone's probably got their view on this, but certainly in my experience, there's an element here which is what you might call the pernicious influence of bureaucracy. And I think this has led to both a kind of demand push and what I might call a supply spill.
It's like the kind of regulatory arbitrage of being regulated only by the FCA and not having to do all the PRA stuff as well and let someone else do that.
That's a really good point, actually. But no, that's not what I was referring to.
The lack of capital.
What I'm thinking about is this thing. When Owen and I started in the market, and probably in your early years as well, Mark, there were a lot of smallish players with highly talented underwriters, whether they be Lloyd's syndicates or other, who were very successful. Owen worked for Catlin, which is now no longer, but it was a great business. What's happened? Catlin sold itself to Excel.
Yeah.
So companies which are small, medium size end up getting subsumed into larger companies. You end up with these vast insurance groups. Some of them are good, some of them are not as good perhaps, but they all are characterized by bureaucracy. They all have to have the systems and procedures in place. The philosophy when you run a large business is you need efficiency in your operations. And what falls out of the sides of that when efficient operations is the most important thing for you? This is the supply spill, for want of a better expression. Underwriters who feel special, niche, different, better than the average, not identikit, they often feel not at home in a large bureaucratic company. And so they're looking for opportunities to be able to be more in control of their own destiny. And they often go down an MGA route, set up their own or join in a small group of people. So they're exploiting the existence of this model, dropping out of companies. Then on the other side, on the demand push, what's creating other demand for MGAs, where you've got a new business idea, whether it be a unique way of handling flood insurance or a new unique distribution product for an SME thing or
something like cyber.
Or cyber. I'm thinking companies that use external data sources to inform pricing or whatever your new idea might be. Some are good and some are bad. But it's not going to be easy for those idea generating people to join a large insurance company. They won't fit in. They're not agile enough. They're not flexible enough
and
to
the company won't want to
them.
write it 100% straight away. So the MGA is automatically a great way of syndicating that.
Yeah, exactly. Yeah. And don't forget, even in large companies, you often find that a new line of business will, they say, well, I only want to do it if I get reinsurance backing from Munich Re or something, right? You'd always find this thing where people want to mitigate their risk in some way. So the MGA is a form of being able to separate capital from distribution.
Just take a 5% line on this 50 million MGA, and that'll be okay. And at least I can get a flavour for what this thing's all about.
Yes. And later on, that niche idea might become a big important idea. So this company could then put it into one of its great big organised verticals that it does. But anything that seems to be in any way not standard in one of those traditional verticals, SME, personal lines, mass market, commercial property, anything that's not that seems these days to be going into the MGA route. In terms of where that might go in the future, I can't see companies getting smaller. I can't see bureaucracies doing away with themselves. So
I think big companies are recognizing this because you're seeing more innovation hubs and things popping up within large companies who are out in the market talking to new MGAs and startups and so on. You see it at Lloyd's as well. Lloyd's have the ICX, is it? Risk code, the proportion of innovation that they're allowed to have in the business plan, which attracts, I think,
that's balanced for MGAs as well, isn't it? They're most likely to.
Almost certainly, I would think, yeah.
My other pet theory is, of course, 30 years ago when I first met an MGA, you knew it was adding 10 points to everything because we walked around with paper files and the money moved much more slowly. Mm-hmm. Now, the technology has removed a lot of that frictional cost. So I would say it's removing one of the barriers to say, I'm an underwriter, why don't I just do underwriting and leave all the other stuff to all the other people?
And by the way, just a historical perspective, don't forget, for 300 plus years, we've had MGAs. Yeah. A Lloyd's syndicate is effectively like an MGA, isn't it?
Yeah, of course, absolutely.
You're separating the underwriting and distribution aspect of insurance from the risk-taking, capital-bearing aspect of insurance. Yeah. So the model has endured for centuries, actually.
Yes, so for me, I just thought the final sort of icing on that cake is that lack of frictional cost. So you don't automatically add 10 points every time it changes hands, and that premium could be looking through very quickly. And now with the MGAs, of course, if they're younger, they like to have better technology.
Yeah,
than
they
the
are.
carriers.
Yes, yeah.
And of course, if they've got someone like you, they've got even better technology.
Well, if you can make some good use of the data, and that is the most important thing. We're coming into the softening market now. Some of the US D&F rate changes that we've seen in the last few months have been quite eye-watering. Obviously, they were eye-watering going
On
up,
the way up.
but now they're starting to become a little bit eye-watering on the way down.
So, the surplus market always, the highest surplus and highest excess will always do that, because it was last on the way in and then it's last on the way out.
It'll filter through, and we're going to see a gradual softening of the market, and we'll have a soft cycle for, I don't know, half a decade. Be interesting to see where it goes.
And of course, officially, we've had Rachel Turk has actually made a very particular point to the Lloyd's market about she really, now that the market's softening, she really wants to look at delegated.
And we
business.
really agree with Rachel Turk.
Well, it sounds like she's drumming up business for you. You have all these secular trends in your favour. More MGAs and more scrutiny of MGAs. Sounds like it's good for business.
And
We're feeling comfortable with things.
we are, but also the nature of the new MGAs in recent years, I think, is different to the past. Because quite often MGAs historically have been parts of broker businesses, whereas most of the new MGAs popping up now are being set up by underwriters or CUOs leaving insurers. So they're used to that portfolio management process. They're used to managing that top line and bottom line conflict. So again, that hopefully will help us engaging with those CUOs.
Sometimes it was just pure distribution. So if I'm a broker, I like to shift this product around quickly and in the most efficient way. So MGA is going to be my way of doing that. And I don't really mind about the underwriting side. Well, I leave that to whoever's providing the paper. Yep. But now, yes, it is. You are right. There's core underwriting at the core of it, and if it's peopled by people who used to work at the big carriers.
Yep. And they'll run that business for 5 to 10 year time horizon.
What about your own business? You set up a business. Sometimes you have an idea. When people set up a business, they have an idea, sort of goal for themselves. What's your vision for Calibrant? Do you would sort of want to be sponsoring the Super Bowl or something one day? Or do you have particular sort of goals that you've set for yourself?
Well, I think portfolio management will last longer than I will last in the industry. There is something very satisfying about thinking that you might, in a small way, influence the way the market thinks about things. And portfolio management, as we've tried to articulate, is ripe for this. It's fallen through the cracks of pricing and reserving and underwriting. The actuarial profession should have perhaps been on this a bit earlier, but Solvency II added a 15-year blockage to it. So portfolio management seems to be going places. We've already effectively built 2 businesses on the back of portfolio management. I could see us potentially moving more into the transaction side. You could imagine partnering more with broking companies of like mind. We could imagine perhaps more leaning into the software side and going that way. But I think always the core idea that portfolio management is important, is valuable and can be done will always be what we're about. We evangelize for it. We're passionate about it. And I think that will be our thing. Whether we end up selling the business, partnering, I don't know. But we're just really hoping that we can beat the drum for portfolio management.
Yes, and would you diversify? Do you think portfolio management is going to be the absolute core of what you always do, what you'll always be known for? Or could you diversify into other things? Other lines, other services, for example?
Yes, and that's what I was trying to sort of articulate. Yes, I could imagine that. Could we become more of a pure transactional player? Yes, but our bent would be, it will be about understanding how a portfolio is being managed and can be managed. That will be our pitch to make a deal.
We'll only place it if we can manage it.
Exactly,
Yeah,
so
we can help you manage it.
So I think we can take a core concept and turn that into various different commercial applications. We've done services, a bit of intermediation and software out of it so far. I could see us going deeper into those areas, or I could see us expanding into more things, maybe focusing more on the transactional side. I don't know. It might be more geographical. We've already got a presence in the States through a partnering arrangement we have with a firm. And we've got our first couple of US MGA clients on the books now. So where we go, we don't know, but it will always be around the management of portfolios.
Yeah, and of course, they wouldn't have to be MGAs. It could be with one of these big vertical carriers.
Absolutely, yeah. It doesn't have to be delegated authority. It's just that's so existential for an MGA that seems to be where most of people's focus has been.
And the concept transfers very neatly across into algorithmic underwriting, where underwriting decisions are being made on portfolio level rather than at the risk by risk level. So there is very little difference between managing a scheme versus an MGA versus a
quota share treaty.
Or exactly. Yeah. Short term, I've got my eye set on that almost 40% of the Lloyd's market that is MGA. That's a big prize for us to go after. And most of that fits within our model, where you've had attritional loss, some large loss, a bit of cat. Let's say 80% of that 40% sits within our sweet spot.
If we wanted to develop some marketing materials, I think some direct quotes from Lloyd's would be quite helpful.
They're already in use, Simon.
Yeah.
Yes, absolutely. Yes, they're certainly doing a good job of making people aware that your services may be required. Oh, one last thing. I was checking on a website that you've got an alliance with a broker called Andersign.
Yes, Andersign. This is I just alluded to our presence in the States, a partnering presence.
Right.
So Andersign is a US-based small team of very experienced reinsurance practitioners. And as you've kind of been touching on, Mark, everybody has been gravitating towards MGAs. And although their background is reinsurance and large one-off deals, they have in recent years, got a lot more involved in MGAs and facilitating MGA transactions. I worked with the founder of Andersign many years ago, and we're good friends. And so there's a lot of mutual trust there. They like what we do, especially the software. And so they are our feet on the ground in America for the software, in particular the software. As just mentioned, we've got a couple of US clients. We've got 2 or 3 more in the hopper, hopefully. And it's always helpful to have someone in the same time zone who actually talks intelligently about what you're trying to do to be able to be an on-the-ground contact point. So that's our partnership with them.
You can't be everywhere. And of course, just sitting here in London, you've got so much to be getting on with over here.
Yeah, exactly.
And also the European market, apparently from what I've seen last week, it is growing at a faster rate than UK and US in percentage terms. Obviously, it's nowhere near from a smaller base. Yes, it's nowhere near as big as it is in US, Canada, UK, but the rate of growth is faster.
It sounds like the world's absolutely your oyster. And I've run through everything that I had on my list of questions. Do you think we've missed anything, any parting shots, or anything we think we should have talked about that we haven't talked about yet?
The importance of silos, removing them, just get the culture right. We're a bunch of actuaries, or at least Owen and I are.
You're used to being siloed.
Well, yeah, and when Owen started in our career, I was thrown into reserving, pricing, analysis of reinsurance outwards, all that kind of pricing in was reinsurance treatise. You did everything as an actuary in the early days. And if you couldn't brush up against opinionated, powerful underwriters and make them sit up and listen to you, then you weren't going to be successful. So Owen and I, we got our training when actuaries were kind of jacks of all trade, at least in the analytical sense. And nowadays, of course, you've got actuaries who are only Solvency II capital actuaries.
So you've got silo within the silo.
So really, it's really important if we want to be successful in managing portfolios. I know it's not a new point, but I want to reiterate this. Just think about being able to harness all the people, all the functions in a way that they come together transparently to deliver single versions of the truth so that the people that make decisions can make well-informed and credible decisions.
That sounds good to me. If I was an underwriter, I would want to be fully informed about what does everyone else think of what I've just done. Was that good?
Yes.
Or was that theoretically bad? Do I just have to hit and hope? Because it's theoretically unprofitable, but of course it might not have a loss, so okay.
Yeah, exactly. Yeah.
But not necessarily okay. Not okay. I'm not going to get a gold star for that one, am I?
To be fair, if an underwriter doesn't want to know, then his or her boss should probably be a little bit worried.
I mean, in the end, that's not a sustainable way of working,
that's
is
right,
it, for anybody? In fact, nobody really wants to buy insurance off somebody who doesn't really want to know whether they're doing something that's theoretically profitable or not.
Exactly.
Because that's not sustainable.
It's in everyone's interest that the market exists for
They're not
the
going to
long
be
run,
around,
right?
are they?
Yeah, exactly. Yeah.
I've really enjoyed talking to you. It's been really good fun. I suppose, yes, I've spent a lot of this podcast talking to actuaries who are really good fun to talk to. So I'll see you down the pub.
Excellent.
Thanks for coming.
And you, Mark. Thank you very much.
Thanks, Mark.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.